it's usually not easy. A lot of people start, they don't finish. You know, a lot of people start, they do not finish because the journey is, and that's why you see somebody, you call him, he's a painter, he's a bricklayer, he's an electrician, he's a contractor, he's an agent. He's only one person, he can do everything. Why? Because, yeah, and he's still poor, he's still broke. Is he not? Yeah. Still broke, very good. He's still broke. You know, so when you take your time to study one particular thing and be exceptionally good, you continue to innovate, because that's the thing. That's the problem with Union Bank. They didn't move with others, is it not? Yeah, they were still using teller. They were still using teller. They were still filling form. So you have to embrace innovation. We're always in the forefront of innovation. As we are trading, we have a trading community. When we see something new, they bring it to our attention. They are always enhancing our platforms. The one I'm going to use to teach you is not the one you eventually use. The one I'm going to teach you is typewriter. So when you now learn with typewriter, ASDF, column, JKL, is it not? You start like that. Then when you have understood it, you will now come in and then you start to learn how to, you know, use other more complex, and I can't do all of that in this workshop. You get the point now. So that's why the training will still take some time, so that you can familiarize yourself with all these other tools. You get it? So those of you who are chosen, let's continue. If we had 5 days, by the time we get to 5 days, I will now see the real number. So yesterday, of course, you cannot compare the actual seminar to the workshop. Seminar, workshop number drops, day 2 workshop number will further drop, you know. So it's very normal. I'm not surprised. I'm even impressed. Is it not? I'm impressed. They know what I'm talking about, because their own said they were fewer, you know. So it means that I think the hunger is really heightening. Is it not? So more people are now looking for, you know, ways. And then God will help us, because in Nigeria, it's easy for you to do the wrong thing to make money, is it not? It's easy. So when you now pursue something that is right, okay, we are now hoping that God will now bless the work of our hands as he has promised. You know. Okay, so I just left this slide so that you will remind me of what we did yesterday. Let me be sure that you have not flushed that one, you know, this morning. Okay, so let somebody tell us in your own terms what win rate is, what risk to reward is. What is your win rate? If they say, what's your win rate, what does it mean to say, what is your win rate? Yeah, you talk to me before we start. Yeah, let me hear you.
Win rate can be defined as the amount of times that you are right.
Yeah, that's correct. It's simple. Win rate. How many times you are right? Okay, so if we measure it in percentage, so if you are right 60% of the time, you say your win rate is 60. Is that okay? So that's win rate. And then the win rate comes from your edge, is it not? Yes. So because you have an edge, you now have a win rate. Sometimes your win rate can be 40%, but you still make money if your risk to reward is good. Do you understand what I just said? I will show you the math in that one. If you say, okay, I want to take a trade that is 40%, but on this trade which is 40%, low win rate, I'm not going to stop at 1:2. I'm going to go as far as 1:5. You make money, is it not? Because if you are right 40% of the time, and whenever you are right, you win you're winning as much as 5 times what you're losing when you are wrong, right? You still make money. Because at the end of the day, you'll be multiplying 5 times 4, is it not? And then 1 times 6. Do you get my point now? So, what is risk to reward then? What's risk to reward? Yeah.
Your risk to reward is the amount of money you intend to put into the market in commensurate to your expected return.
Okay. That's his own grammar. It's correct, is it not? So your risk is the amount you are willing to give out. And we were talking about gamblers and traders yesterday. A gambler is a risk taker. A trader is a risk manager, is it not? Yes. When you say a gambler is a risk taker, it means that when he takes he plays a game, he's saying that all this money is gone. Is it not? If you take risk, you are saying, I'm taking the risk that I am fine if I have a loss. Do you understand? That's what it means to take risk. That's why when you do some investment, they will tell you, don't put what you are not willing to lose. Is it not? So because it's assumed that that thing you are taking a risk on, you are not taking the risk because you believe it will come back to you. You are taking the risk because you have accepted that this money is gone. If it comes back, good and fine. Is it not? But if it doesn't come back, I will go. And then usually when you risk too much, you won't sleep well that night. You'll be quarreling with your wife. You'll be angry with your neighbor for nothing. You know? So that's a very big difference you have to understand. And then going forward as a trader, you have to learn to accept any amount you are risking. Because that risk is the deposit you are making to take that trade. So when you take a risk, we call it a faith deposit. It's a faith deposit that this thing will go in my favor. So if it doesn't work, you go. It's not every time you sow seed that the prayer will be answered, is it not? When you kneel down and pray to God, you can be sowing seed, you sow, is one day God will decide to answer your prayer, is it not? So it's a faith deposit, it's the seed you are sowing. So when you sow a seed, you can't sow a seed to a pastor and go and tell him to give you back, is it not? I mean, can you go and collect your tithe back from the pastor? You cannot collect it back. So that's what your risk is. That's what I want you to understand. If you cannot give the pastor that amount of money, you won't give the pastor, is it not? You give the pastor what you can afford. It's just that these days when they are preaching now, they will let you know that this man gave, yes, they tell you that the number of ram he gave up to today, nobody has given that amount of ram. Solomon. You know, that's what they used to preach. And then they tell you to give all the money in your pocket, that before you reach home, somebody will surprise you. You know, so those are not the kind of churches you're talking about. I'm talking about the normal place where you just, put the little you have, your seed, and then you go. You are not worried about it. You are now praying that God answer my prayer, is it not? Yes. So you are now hoping that the trade should come out well. So what I'm bringing your mind to here is risk, because that's what trading is about. If you cannot understand this part, you find it very difficult to succeed as a trader. If $20 is too much for you to risk on $100, you shouldn't take the trade. But if $2 is comfortable, you should. That's what we're saying. You can give out $2, you will not feel it. But if you're giving somebody $20 now, you think it twice, is it not? Yes, you think it twice. So these are some of the things we talked about. Who can tell me what it means to think in probability? Thinking in probability. What does probability mean? Uncertainty. Probability doesn't mean head or tail. So but you're right. Yeah. Chance. Game of chance. That's probability. It's probabilistic in nature. The best we can do is to make the probability work in our favor. It's just the same thing for those that are even playing game. If Barcelona is playing against, no, not Barcelona of today. If Chelsea is playing Aston Villa, why are you calling man? You are looking for trouble now. So if Chelsea is playing Bolton Wanderers, the odds, the probability is high. It's a probabilistic game, is it not? But the odds are in favor of one of the teams, is it not? That's what you would do for yourself when you now learn a strategy. So you now make the odd in your favor. But do you know that Bolton can win Chelsea that day? Chelsea can get red card in the first half. Is it not? And spoil the result. It doesn't mean that the probability was not in their favor. So what I want you to understand is probability. You get the point now. That's the way the market is. You cannot be certain about anything, no matter how good you are. Or no matter how brilliant your strategy is. Yeah.
Please try to remind me what you said about when you were talking about probability.
Yeah.
You added a point that sometimes you can add to one side so that you will get the
Yeah, that's the edge. So we said that if you flip a coin, it's 50-50, but when you put weight on one side and flip it, it will now start falling more on one side, either head or tail, depending on where you add the weight. So what we're now saying is that weight that you're adding on one side is your strategy. And let's not just call it strategy so that you don't get it wrong. It's your education. Is that okay? It's your education. Because strategy alone is 10% of what is required to succeed. So strategy is not important. What is important is your money management, the rules as well, and then your trade psychology. Is it not? And I told you that once you can think in probability, you don't have any problem with trading psychology. That's just the only solution. Thinking in probability. If you know that Okay, clusters. What are clusters? Clusters.
Clusters are accumulation of losses gathered over time or profits gathered over time.
Yeah. It's just clusters, we call them series or consecutive wins or losses. So if you win. Do you know that there's a problem with clusters? Are you aware? There's a problem with cluster. We call it euphoria. Euphoria. If you have 10 losses in a row, you're going to have problems, is it not? Yeah, upstairs, you start to feel somehow. Now, it's better you start to feel that way so that you are still in control. The worst is 10 wins in a row is dangerous. If you take 10 wins in a row, you enter into a state of euphoria. You start to feel like a small god. You start to feel like you know everything about the market. And you start to feel like your strategy is 100%. And you start to feel like you are now a professional. Then you know what you do next? You increase your lot size. So you can see that that is also very, very terrible. If you're not trained, to be disciplined, you win, you start to increase your lot size. That's what many of you do, those binary people and these people that they will test you with demo accounts. When you do, you will win. When you do, you win again. When you do, you win. You now go and put real money. Then you now start seeing the real results. You know. Okay, drawdown. What's drawdown? Yeah, they result from your clusters. So that's what gives you a drawdown. And then recovery. And I taught you something important yesterday. I said that you have to avoid drawdown at all costs. Is it not? Yes. At all costs, because that's what is going to invite emotional imbalance. Okay, so avoid clusters. Avoid drawdowns. All right? If you have a good system, you can regulate your cluster of losses. And then if you have a good management, money management rule, you can also regulate your drawdowns. Because if I start trading today and I have losses today, and I have a place where I tell myself I will stop in a day, it will stop me from having clusters, is it not? But if you don't have that rule, you open your computer to trade. You can trade from 6 a.m. to 6 p.m. and you are losing. You understand what we are saying now? So you now end up still having a cluster, even though you are managing your risk. But because you have taken too many trades in one day, you take a big loss, right? Okay, so that's very important to take note of too. Then risk per trade, we have the rule. What's the rule? Maximum risk on each trade is what? That's what we agreed. Now, but there's another problem, or there's another level to it, which we cannot cover here. This is a general rule. But now, if I'm a position trader, I cannot use 1%. Are you aware? Yeah. Do you understand what I'm saying now? If I am a swing trader, and I'm taking just, let's say, 2 trades in a week, or 3 trades in a week, if I use 1%, it will not be too good. Do you understand? It makes sense, Abi. If I'm the one when we say 1% is for a day trader, a trader that hopes to close his trade that day. That's a day trader. You start in the morning and you close it before the end of the day. That's a day trader. Okay? Once it has passed one day, you are not a day trader anymore. Is it not? You have changed it to swing. Okay, so the rules are different for the different types of traders. That's what I'm saying. All right, so just take note of that. So you know what you are doing. If you're going to hold a trade that will run for weeks or days, if you use 1%, you won't like the return on investment. You understand? After this number of weeks. You get my point now? So you take note of that. No, it depends on what trade you are doing or what kind of trader you are. So there's no which one is better. I explained that yesterday. That is left for you. If you want to trade every day as an intraday trader, it's your choice. You can wake up in the morning, place your trade, and hope to close it before the end of the day. So the time frame you're using, I showed them to you on that slide, you know? Yeah. So you know what time frame to use that will be easy for you to end up getting to your target before the end of the day. So you cannot use a daily bar to do an intraday trade. Is it not? Because you need several daily bars to get to your target, depending on where your target is. You get what I'm trying to say now? So that answer is, this will answer your question now. Yeah. So it depends on what you want to do. All right. Okay, so we have all these ways as ways to analyze the market. Because the question now is, now that you have understood to a very good extent check the size. Jesus, this thing didn't enter where it's hand.
No, that's a small bit.
Understood all those concepts, because those things are concepts I'm giving to you. And I have a reason for starting from those things, so that your mind will begin to, understand some, methods or ideology for Forex trading. Now, when you have understood these things, the next thing now is the actual analysis, is it not? How do I place a trade, buy and sell, is it not? So how do I enter the market? There are 3 ways. That's what we're talking about. There's what we call gut feeling. Gut feeling is you wake up, you feel happy that day. You buy Euro USD. Some people trade like that. They can wake up, they just look at the chart. Let me see. Yeah. Let me see. It will buy you, it will place, is it not? It will place. You just click buy, that's all. I told you to trade is not difficult. So if you want to use gut feeling, it's okay. After all, that's what gamblers do too. Is it not?
Can we call it intuition?
You can call it what? Intuition. Before he's asking a very good question. If we can call it intuition. Now, there are 3 stages of trading. Right? There's the mechanical, which is where you are going to stay for now. That's the stage where we tell you A plus B equals to C, do not digress. Is it not? We tell you this is a method. We do these things with indicators. Is that okay? So they are mechanical. You're not applying any knowledge of anything to it. The signals are there. So when the signal, maybe when the line crosses, or when this thing happens, or when this bar forms, you place your trade. Is it not? That is, that's the one we call mechanical. Okay? Some people use what we call a Fibonacci tool. Yeah. They call it the Fibo levels. Right? Now, if they can decide that they want to buy pullbacks that will come to one of the levels. Is that okay? So they are not doing anything intuitive. Once there's an uptrend and there's a pullback to any of the level that they want, they buy. Do you understand? They will just buy immediately without thinking twice. Okay, so they are mechanical traders. Now, there are other levels, but then after that point, you now get to the point where you become intuitive. Intuitive is the highest form of trading. Intuitive is somebody who is a professional. You can only be a scalper if you have reached the level of intuitive trading. So that you know what to do instinctively. You manage your risk instinctively. You know that if the market goes against you 10 pips, you cut it off. Intuitively. It's not, yeah. Some of you have gotten so good with your profession that you don't need your rules anymore. Is it not? Your book, you don't look at it anymore. You know what to do at every point in time. Right? So that's intuition. So gut feeling is not intuition, sir. Is it not? Because you don't even know anything. And you are looking at the computer and you can even call your son and say, look at this market, what do you think I should do? You know, what do you think I should do? And then the young boy said, Daddy, buy now. Buy. Then you now do the sign of the cross. And then you buy. Then you now say, Mother Mary did not intercede for you. You know, so you have to try as much as you can to avoid it. Gut feeling is not something that you do because you want to do it. It comes from emotion. It's emotional trading. So when the market has destabilized you, you find yourself trading out of the blues. You just buy, you just sell, and you hope that it's working. You don't know where to put your stop loss. You don't know where to take your profit, but you are in the market. All these things are gut feelings. They are wrong. Now, the other way is fundamental analysis. See, when you look at fundamental analysis, you see that it's the only reliable way to actually trade Forex. When I say reliable, it is 100% reliable. But there's a problem with it. See, fundamental analysis is not news trading. Don't get me wrong. News trading is entirely different from fundamental analysis. If I talk about fundamental analysis, we're talking of taking the economic variable of the country and then we factor it into their currency and see the strength of the currency. Now, see what I'm saying in layman's language. If Nigeria's economy starts to improve because more people have jobs, because more companies are manufacturing, because exportation is taking place, right? When all these things happen, it's called fundamental. These are the things that are tying our naira. So naira is directly proportional to our economy. Now, when you look at the economy, why is naira falling? There is no job, is it not? There is no manufacture. There is no production. There is no exportation. Only importation. Yes. And then somebody is saying there's no security. It affects the economy. Because As a foreign investor, I know there's Boko Haram, I know there's bandits, I know there is ungun known men, I know there is kidnappers, I know there is this. I will not come and partner with you. There's headsmen. I cannot come and partner with you or build an industry there. Yes. Even if I say, let me come in and you have land, I want to do your agriculture for you. I come in. The next day I can hear the herdsmen, they have gone and eaten up all the crops with their cow. Is it not? So these are factors that affect Naira. That's the truth. What I'm telling you now is the truth. That's why I'm telling you that it cannot drop. Do you know that CDs used to be very big before? When they're talking of 1 million CDs, if they bring it here to Nigeria, you will use it to buy just maybe one plate of food. Before. But do you know that CDs is approaching dollar in terms of value? Do you know that South Africa is approaching dollar also? And do you know that we can trade South African rand on Forex? We can't trade Naira. Are you aware? What happened to Ghana? Ghana's economy improved. Is it not? Do you know that there was a time we chased Ghana away? The way South Africans are chasing us away. There's a time we chased Ghanaians away, told them to go back to their home. They are taking our resources up. That's what America is doing to these people also, Haiti and the rest. They chase them away, and then they make sure there is no camera. But once young boy camera the show, so it's on CNN now. You know, so they don't want them to come and consume. Now, there's a reason for it, and that was when we had some reliable government. Is it not? Yeah, there's a reason for it. There's a time when Fashola sent away all the handicaps and all those guys. He sent them away. He carted all of them away and dumped them in Onitsha. Overnight, we just came and saw that Oshodi, Yaba, there was nobody under the bridge. There was nobody on the road again. You know? So, the reason is you people are putting pressure on our resources, you know, and it affects the economy, the revenue also. Okay, so the bottom line of everything is that it is the economy that determines the currency, and what we are trading is the currency value, is it not? So if I know that Nigeria is not manufacturing, they cannot start manufacturing overnight. Even if they start the project, it won't happen immediately. So you can see why fundamental analysis is better. Do you get my point? So the only problem we have with fundamental analysis is that even if Nigeria starts to manufacture today, we don't know when the dollar will rise, is it not, or fall. You get my point now? Even if they start to produce crude, and we change it to all the products here in Nigeria, and we start to use our thing and export, over time, dollar will fall. Is it not? Over time, dollar will fall. But there is no stop loss. There is no take profit. Do you get the difference now? Do you get what I'm trying to say? There's no, it's going to happen tomorrow, or it's going to happen today, or it's going to, you know it will happen. Unless you want to now say, okay, let me just open my trade because Nigeria is becoming better. Let's now trade against the dollar. So, but for the sake of monthly return on investment, you have to rely on technical analysis, and that's what makes Forex probabilistic. Do you understand? So, because technical analysis will tell you where to buy. Fundamental can tell you what to buy, is it not? But it will not tell you where to buy. That is, buy tomorrow. It won't tell you. It won't tell you take your profit at so price. But technical analysis is going to tell you put your stop loss at 10 naira. Put your take profit at 20 naira. Is that okay? So you have to understand these two things. So what we are learning is TA, not FA. Is that okay? So, and they are two separate disciplines. I see people who say that they are they do fundamental analysis and technical analysis. They don't know what they are saying. I see them a lot. I just laugh. Because if you're going to be picking up variables we are talking about is non-farm payroll, for example, in America. Developed economy, that's the only place you can do fundamental analysis. Non-farm payroll, we are talking of what was the number of report of unemployment last month? How many people said, America have SSN, everybody is accounted for. Are you aware? Yes. Every soul walking on the street is accounted for. So, if you don't have job today, that minute you lose your job, America knows that you have lost your job. Do you understand? They record it as 1. Is it not? 2, 3. They record it like that. So by the end of the month, they know the total number of people who lost their job. Do you understand? Now, the fundamental analyst will pick that number and compare it to the previous number. Then they look at manufacturing index. They look at the gross index. They look at production. They look at other things that has to do with the economy. They look at manufacturing. There are so many things they look at. Now, all these things have numbers that are associated with them. It's not just a random thing. So we compare the previous number to the new number, and then we now say, okay, last month, there were more people now have jobs. So if more people have jobs, it means that there is more manufacturing, is it not? There is more, production. So it means strength for the currency. Do you get it now? So I'm not going to go into fundamental analysis. You won't hear me talk about fundamental analysis at all. Because that thing is difficult to do. Do you get my point? It's not that it's not possible, but it's difficult because the variables are too much. And for you to take the variable of all the different countries and their currency is going to be difficult. You get the point now? So, and there's something that works and works better. Even if you do that, that thing still will not tell you where to place your stop loss. Do you understand? That thing is not going to tell you that if you want to reach $1, if you want to reach 1,000 naira at so price, that's where you take your stop. It won't tell you. Or when this market, let's say a can of malt, which is normally sold at 100 naira, it will tell you that fundamental analysis, which is the variables I've been talking about, is not going to tell you the price. It can tell you, okay, people are started complaining that there's too much sugar, or people are complaining, or some of their companies have burnt, or the government is probing the company, and they're having issues. So it means that their product will become scarce, and the price will rise. Is it not? Do you understand what I'm saying? Yes, sir. Okay, so, because if the number of malts that they produce reduces, the price will increase. Is it not? So if it's only 3 shops that have malt in the whole community, they will sell it for 500. Is it not? That's what we do in Nigeria. So what I'm trying to say is, fundamental analysis can give you that information. But technical analysis will tell you that if the malt drops below 80 naira, take your 1,000 naira loss and go away. Because it's possible that the company wants to crash. Do you understand? That's what technical analysis tells you. Technical analysis will also tell you that there's a high tendency that this malt is going to become scarce, and it will likely sell at 150. So when you are trading malt, if the price rises from that 100 where you bought it and gets to maybe 140, take your profit and go. Do you understand? That's what TA will do for you. So TA tells you where to stop and where to take your profit. So TA will tell you stop at 80, which is 20, and stop at, let's say, 40, which is 2 times of 20. Do you get the point now? So something can happen and that malt will start to fall. Maybe people don't want it again. There's a new brand, Better Malt or Maltina or yes. So they will be forced to reduce their price to maybe 70 naira or 50 naira. Is it not? You get what I'm saying now? So these are the factors that affect this price, and they can be identified by TA. That's the point. You get it now? So what I'm going to be teaching you is TA, not fundamentals. So we're going to learn where to buy, where to stop, and where to take our money. And you must follow the rules. Is that okay? You must follow the rules. So, like I said, we're going to focus. Every other thing you're doing is not gut feeling and is not fundamental. It's pure TA. Okay? So, these are the principles of technical analysis. Okay? I had that slide, but I've removed it. Can somebody give me the principles? Principles of TA. What are the principles of technical analysis? There was a $10 I was supposed to give you yesterday, so I can give you for $10. Principles of technical analysis. What are the, you know what principles mean? Principles are not, they are not hypotheses. Principle means law. Like law of gravity. Is it not? If I leave this thing, it will fall down. It's a law. Right? It's a principle. So, what are the principles of this technical analysis I'm talking about? Oh yeah, let me hear from you.
One, I think history repeats itself.
History repeats itself.
And two, whatever happens in the fundamental can still show up in the technical analysis.
Okay, makes sense. But you did not give me in the right grammar. Hold on, let me finish. Yeah, it's remaining one. That's where your fuel finish. Unfortunately, we cannot tear that dollar into two. So, what do we do? No. History repeats itself. Okay, you are just employing your native wisdom from what I have said. No. Yeah. Sorry? No, these are not principles. When he said history repeats itself, it's a principle. We're saying that if the market always, if anytime this thing happens, the market will get to 20. Let me say the malt case I gave you, 80 to 140, right? Is at 100 now where we are buying. But we are hoping that it will get to 140. So we buy it. But if it starts to fall and go to 80, we will just take our loss, is it not? 20 naira loss and go away. Now, history repeats itself says that the thing that made it to lose and go to 80, if it happens tomorrow, it will still go back to 80. Yeah, that's history repeats itself. The same way, the condition that made it to rise to 140, if it happens in the future, it will rise again to 140. That's the first principle of technical analysis. It's saying that whatever happened before can happen again. That's the first principle. The second one.
Everything in fundamental.
No.
Everything in fundamental can
No.
be displayed in TA.
Everything in fundamental can be displayed in.
Fundamental say that, let me say, the euro is having strength. We can see in
I will help you because it's remaining one. What he's trying to explain is that, yeah, price discounts itself. That's the second principle. The market discounts itself. Everything reflects on the chart. If Donald Trump or Joe Biden is saying something about America that is going to affect the economy or that is going to affect the currency, I will see the bars will start to move. Is it not? On my chart. Do you understand? If, let's say, a company like Ford is going to import cars, a lot of cars, maybe 5 million pieces of cars, the latest model, into America, do you know that they will pay for it in dollar, is it not? And it's going to affect the dollar because of the weight of the amount coming in. Is it not? Toyota is going to ship some cars. They will pay for it, is it not? So that is going to affect the currency. Now, I don't need to call somebody working into Toyota to say, when are you going to make that payment? Do you understand? You will see the breakout bar on your chart. Do you understand? You will see the bar. It will show you that this is happening. Yeah, you might not know what is causing it. You don't care. We don't care. That's what TA guys do. We don't care. But on our chart, when we look at the chart, it will tell us, what is happening with the economy. Is that okay? So that's the principle number 2, that everything reflects on the chart. Price discounts itself. That's what we're saying. Okay, so what's the last one? Last one.
Price moves in inertia. That means if the price is now uptrend, it is more likely to rise.
Yes. Give him $10. No, but he's the one that gave us the last one now. No, give him $10. Where is he? Give him $10. He has won it. All of you have heard the first two. We're waiting for the last one. There are some exams that we have written that if you don't write the final answer, or if you don't write everything, you have written exams now. You have to write everything complete. So it was the last one we needed. And he has told us that price moves in trend. That's a very important point. See what we are saying. We're saying that as a principle, if the market has printed a sign to tell you that it is starting to rise, it's telling you that it wants to continue rising. It doesn't happen all the time. But it is saying that, give to him. It's saying that prices move in trend. So if the market is not moving in trend, don't put your money and say it will move in trend. It will continue staying in a range. Do you understand now? Yes. So we're saying the market moves in trend. So if the market is moving, is trending sideways, let's put it that way. Okay, it's not going up, it's not going down. It's just in a range. So we give benefit of the doubt to that range, right? Until we can all clearly see the market erupt from the range and start to move in a trend. Then traders will now say what? That the market is now moving in a trend. Do you understand? It's now trending. Okay? So the market moves in trend. Now, these are the 3 principles that enables us to use technical analysis. The principles are laws. They are laws. They are not. This is what is helping us as forex trader to generate return on investment consistently also. If you know that history will repeat itself, if you see the opportunity, you will take it again. If you know that the price will move in trend, when the trend starts, you will join the trend. If you know that everything is discounted on price on the chart, you don't need to worry yourself about sourcing information from the country or from the company or wherever. You just need only your chart, is it not? So what we are saying is that the chart is self-sufficient to give you the instruction to buy or to sell. You have to, as traders, try as much as you can to make your strategy simple. Very simple. Because if you use complex strategies, you are going to suffer, missing a lot of opportunities. Okay? So we simply define technical analysis as the identification of trend and their reversals. That's your business. Your business here is to say, where is the trend and when is it going to turn? That's when is it going to reverse. That's all that's your goal in TA. Your goal is to say, when will the market move up? And when is that movement going to stop? Is it not? When is this mult going to rise? And where will the price stop? That's why we say TA is the identification of trends and their turning point. Okay? Now, these are different concepts. Yeah. Okay, sorry. Okay, we have to move faster. Okay, so some of these things are very important things that you need to begin with so that you will know what you are doing. Okay, you need to begin with them. All right, so when we get into the market, when you understand some of these things, it will be easy for you. It will be easy. You will not struggle too much. Or you approach it from a carefree state of mind. You will not trade with tension. Right? Because you are in control. Knowledge is power. Okay? All right, so these are different concepts that we are supposed to talk about. Basic concepts. There are more to it. When you talk about technical analysis, what you are talking about is, how do I analyze the market to know that there is a trend? Is it not? How do I identify the trend? Okay? How do I know where it's going to reverse? So there are some basic things that you need to know, at least to help you start. Okay? So we're going to look at some of the tools that you can use to identify a trend. Okay? Now there's somebody we call Elliott. Okay, Elliott is a very important person because he was the first person to tell us that these trends, they move in a particular wave. Is that okay? That they move in a particular wave. If you look at it very well, you will observe it. That they move in waves. Okay, so when the market goes up, it will rest. It will go up again, it will rest. It will go up again. That's what it says. Then it will now take maybe a very big rest. Is that okay? That's the trend we are talking about. See what Elliott said. Elliott says that this thing will move in a trend of 5 waves. So he's saying that okay, so just look at what we're saying. Assuming that this is the chart, like this and like this, okay? You have, let's say, Naira against dollar, right? US dollar against Nigerian Naira. Is that okay? We now have, let's say, 100, 200, 300, 400, 500, 600, like that. Then you now have, let's say, 1991, 1999, 2005, 2020, for example. Or, yeah, 2020. Now, this is just an example. When you open that MT4 you downloaded, this is what you will see. Is that okay? So what you will see here is, you will see time here. Is that okay? And then what you see here is what? Is the price. Okay? So, and then what you will now see is how the price is moving. Is that okay? So it means that by 1991, $1 was 100 Naira. You get the point now? Because this is not going to move in a straight line. You get what I'm saying? So now what I'm trying to teach you with Elliott is that he said that this thing moves in a wave of 5. So what you see is he's saying that it goes up, down, up, down, up 5 times. Say that's how he moves. So he said you have up, you have down. You have up, you have down. Then you have up. Then you now have the one that is the final rest. I'm going to show you. Okay? Yeah, so there's something very important I need to also explain to you here. All right? Now, when the market goes from this to this, comes down and goes higher than this point, we say that a trend has started. Is that okay? So anytime the market rises, it goes down and rises. This one did not go below this place. Is that okay? And then this one now go higher than this place. We now say that this is a trend. Just keep that at the back of your mind. Is that okay? You know that other things can happen from here. It can still come down again and go again. Do you understand? So it means that if you have bought somewhere here and put your stop loss here, by now you have about 1:2. Do you understand? You get what I'm saying? Okay, so hold on, we'll go back there. Okay, so this is a very natural representation. So what I want you to understand is that the market will go up. It doesn't go up forever. The market comes down. It doesn't go down forever. Elliott says that the market usually rests. So he calls it impulse and correction. Impulse and correction. The direction it is moving. If it's a downtrend, if it's coming down, impulse, correction. Impulse, correction. Impulse, correction. You get it now? Okay, so the one that moves in the direction of the trend is the impulse wave. So this is the main thing you need to understand. Meanwhile, this one, we call it the corrective wave. It makes sense? Okay. Now, let me share that slide with you. There are other concepts that, you know, we will talk about, hopefully. There's something we call the trend line. Trend line is when you now put a line here. Traders will put a line here and say, oh, this line is slanting down. It means that we have what? A downtrend. Do you understand? If the line is slanting upwards like this, traders will say we have an uptrend. Is that okay? So these are very basic things. Very basic. Support and resistance, another very important concept. Yeah, it's saying that if the market comes to this point and bounce from that point, that is serving as a support. Support and resistance is the floor and the roof. If I'm bouncing a ball between up and down now, this is the support, this is the resistance. Is that okay? So usually what happens is when we talk about price repeating itself, what we're talking about is, let's say that anytime the price of a particular market gets to, let's assume gin. You want to buy gin. You want to buy gin. Now, a pair of gin is supposed to be, let's assume, 1,500 naira. Now, every time, by January, you have, let's say they will sell it at that 1.5. Okay? Now, they can be selling it at 1.5, 1.6, 1.7, 1.5, 1.6, 1.7. But Easter period, they will increase the price a bit. Abi? You will now be buying it at, let's say, 2,000. Is it not? So after Easter, some people can be selling 1.8. Some people can be selling 2. Some people can even come down to 1.6. Is it not? Then when December comes, what will happen again? It will now go up to what? 2,500. Is it not? Now see what we are saying. Look at the, now let me draw the price. This thing here is the price. What you have here is called the price. We can describe it with anything. You can use a line to describe it. All you need to know is that by this time, this is the price. By this time, this is the price. In 2020, it's around 500. Do you understand? That's what you need to understand. Now, we use what we call candles to represent it. I will show you why quickly. I'll show you why when we get there. So, but for now, let me use line, ordinary line. Is that okay? So, it was at 1.5 in January, is it not? It was at 1.5 in January. Now, the price now rose, go down, go up. It now rose to 2,000. Came down a bit. Now, December, it rose to 2.5. Is it not? I see my price from January to December. Do you know that when people now have one Christmas gin finish, when you now come back, the remaining one that you have, you sell it up because you want to travel. Is it not? You can just give maybe your neighbor or someone else that is retailing and say, oh yeah, collect for how much? 1.5 or 1.6. Is it not? Yes. You see the price will come down. You can give her 2,000. As you are entering that period where you pay school fees and pay house rent, you still sell the remaining one. Is it not? Even if you gave that one at 2,000, you eventually sell off. Is it not? So what you now see is that gin now is now cheap again. Do you understand what we are saying now? And then the process will repeat itself. Are you getting my point now? Year after year. Do you get what we are saying now? See, what is happening here is history repeating itself. And then what we as technical guys call this is a resistance. Do you understand? And then we call this what? A support. So this area where the market is bouncing from is support, and then this one is the resistance. And then what traders will look out for, and this is what we say when we say market has inertia, that what is happening will keep happening. It is amateurs that will continue to put their money and say that thing will rise. Is it not? Professionals will give benefit of the doubt to what is going on and say, okay, when it gets to 1.5, I'm going to buy and sell when it rises. Do you understand? When it rises, I'm going to sell, right? I'm going to place a sell order because there's something called sell mechanism. It's still the same thing as buying, but you're buying in the opposite direction, right? So you're selling, you're placing a sell order so that when the thing comes back down, you can offload it and make your profit. Is that okay? So you get what support and resistance is here. All right. So there's something you need to know. The market will not stay in support and resistance forever. Is that okay? Davido can wear a particular jean, this same jean, right? Davido can wear it, or people will see, Davido is wearing this jean, oh. And then everybody wants to wear the jean. Is it not? Everybody wants to wear the jean and put it on Snapchat and Instagram. So what will happen to the price of that jean? Will it go past 2.5? Yes. Yes. So that's why I say it's normal business we are doing in Forex. And then TA can help you get all this information. It is TA that made me draw a line here. These things are the features of TA, if we are still there. Yes, this is technical analysis. So if I draw a line here and the market is bouncing on this line, this concept I'm telling you is what is going on. Do you get the point? This concept I've described is what is happening. So I don't need to go and check the country. I'm seeing it here. Now, what we now say going forward is, okay, if the market now comes, and instead of stopping at 2.5, we are now seeing the market around here. What will traders start to do? They will say, there is a possibility that it wants to break out. That's what we call it. Breakout. So when I teach you breakouts, I'll tell you that you have to wait for an attempt to reverse that fails. Okay, so you don't chase the breakout because there's something we call probes or false breakouts. So the market can pretend like it's going out and then it will now go back down to that 1.5. Okay? Yeah, there's nothing stopping some persons from buying even though there's no Davido in the picture. There's some people can buy 2.8. Is it not? Some people can buy 2.6, 2.7. Yes, some people can buy 3,000. Somebody is saying the same gene. All right. And then what happened? The gene gets scarce because a lot of people are buying it. The few people who have will sell 5,000. Is it not? Yes. Sell 5,000. And then that thing will not remain there forever. By the time my Abba brothers will now see that a lot of people are buying this particular gene, what will they do? Yes. They will produce 500 containers and they will offload it into the market. What will happen to the price again? It will fall. Yes. So you can see the movement of the market is reflected on your chart. Okay? All right? And then we have, of course, when we as professional traders think of a reversal, we want to see the break of a trend. Is that okay? We want to see the break of a trend. We do not trade reversals until the trend line has been violated. If the market is moving in a particular trend, you can see that anytime it comes to this area, it will bounce. Is it not? So if it now comes and exceeds it, it's assumed that the direction is changing. Is it not? It's a simple thing. Yeah, so we can get more technical later, but that's a very simple concept. That you are following a pattern to go down. All of a sudden, you now break the fence. Is it not? It means that you are trying to turn. All right? So those are some of the concepts that you should understand. And then trading range, I've taught you trading range. This thing between support and resistance is called a trading range. Is that okay? So the opposite of a trading range is a trend. Is that right? This is a range. This price and this price is a range. So the market is moving between that range. Is that okay? Is that okay? All right, and then the Forex chart, I have tried to talk about it. Okay, so this is what your chart will look like. Open your MT4 and see your chart. Open your MT4. So somebody should describe what everything is on that chart. Open it, the actual chart. Open any market at all. And then explain it to me. Explain the chart to me. Yeah, anybody can explain. Just look around and then explain what you are seeing. Yeah, you can help your neighbor. You all have to have an MT4. That MT4 is, that thing you are seeing is everything I've been talking about. You can see the line is scattered, is it not? This is why I say when we come to this point now, some of you will now stop. Then the number will reduce again. It's not my fault. I'm trying my best to explain it with Gene and Mort so that you will not run away too much. So, but there's little or nothing I can do. No matter what I say, I still have to take you to MT4 because that's where you place the trade. So, let somebody explain that environment for me so that when I talk, I can now see where you need assistance. So look at it and then tell me, I want to hear, this is the price, this is the time, this is my time frame. I want to hear this is what the price is, or this is what is, you know, it's what I'm seeing. Just tell me your mind. Anybody can talk. Yeah. Okay. JBP USD.
I'm seeing an uptrend.
Okay, you are seeing an uptrend. Yeah, I like that. What time frame are you seeing the uptrend?
15 minutes.
Okay, 15 minutes is M15. So he's on M15 and he's seeing an uptrend. It means that every 15 minutes, one bar will be printed. Zoom in. Is it out? Right? And then see each candle. I'm going to teach you candles next. That's the next thing. So you can see that they don't describe them with line. They use something that look like candles that have rope. That have wicks. Is it not? You are seeing it now. I'll tell you why they use candles instead of line. But you can change it to line if you want. Is that okay? Those candles can be changed to lines if you want. All right, it was innovation that took it to candle. It was, yeah. So initially it's just lines. Yeah, so the candles show us more information than just line. Yeah, yeah. Question? Okay, you want to explain it to me? Let me see. Yeah, you people should try and participate. I don't like my class to be just me talking, so that you go home with something.
Euro USD.
Yeah, Euro USD, good.
Now, but the market is ranging. It's consolidating.
Okay, market is consolidating on Euro USD. Where is the price? Where is the price? That 1 point something, Abi? Good. I will explain that. Then, where is the time?
This is the time. Yeah.
Yes, good. Good. And then this is the actual price. This is the amount. Then this is the price. We call this the quote. The amount, the quotation. Yes, the quote. I'll explain it. Yeah. Yeah, you're finished.
Mine is USDCHF, 4 hours.
Okay,
time.
okay.
Now look at the price now. It's an uptrend,
Okay.
4 hours. Look at the time, look at the price.
Weak uptrend.
Okay, weak uptrend.
Weak up because the pullbacks are very deep.
Okay.
Yes, weak up. It's an uptrend, but it's weak. Until it reverses, then you can now say it's reversing. But it's an uptrend, it's weak. Yeah.
My market is AUD to Canadian dollars,
Yeah.
but it's breaking the resistance.
That's what I'm saying. So why do you think he's breaking the resistance? Why don't you say it's now at the place where it is resisting and it's about to come down?
Yeah, that's false resistance.
You see, that's what we're saying. Even as you're looking at your chart, you're already telling me it's breaking the resistance, and it has not broken, sir. You understand what we are saying? Amateurs are always amateurs. As long as you are just learning, you need time. You cannot just go and put your money. I've told you. You need time. He's telling me that the market is here. Look at what market is that? Okay, AUD card. Switch to AUD card. Now, what time frame, sir? 5 minutes. So on his 5 minutes time frame, the market is having a structure that looks like this and is approaching the resistance. So, but do you know what he told me? He's having to tell me that the market is at resistance. He said that the market is breaking resistance. Do you understand now? So he's already preparing to what? To buy. Do you get my point? It's a natural thing, no, it's not his fault. Yes, it's a natural thing. Most times when you are just starting and the market is in a trading range, you will keep on, anytime it gets to that place, you will buy because you think that it is now about to break. So, but there's something I teach. What I teach is there are some things that you must see before you trade a breakout. If not, professionals give benefit of the doubt to resistance. To trading range. Okay? Yeah.
In the place of USD and JP,
Yeah.
did it break resistance? Let me get to
But there's no trading range.
There was red, this thing. Look at it. See.
No, that red is moving average. It's not it's not a resistance.
Okay,
It's the moving average. It's just following the price anywhere the price goes. Yes. So resistance can only occur if you are seeing multiple repetition from a particular, price range. Well, there are other technical things. Really, we cannot exhaust. We cannot go deep now. What I'm doing, I'm just exposing you to the terms so that you see them. But there are rules for them to know what to see before you say this is a resistance. This is a pivot. This is a trend line. So you learn to draw those things. That's why you take the course. You understand? But what I want you to know is you cannot finish here and then you don't know anything in Forex. Do you understand my point? So that when people are talking about Forex, at least if they say resistance, you know what resistance is now, is it not? If they tell you support, you know what support is.
This is my AUD card.
Yeah.
4 hours, I'm seeing downtrend, if I'm not mistaken. Then
Yeah,
1 hour,
sure.
I'm seeing ranging. Which one do I believe?
That's another thing entirely. You trade your own time frame. If there's a range on H1, It means that H1 traders are still trading up, down, up, down, up, down. But H4 are not affected because the market will not move from H1 to come and stop them out on H4. Do you understand? So you stick to your own time frame. It means that for H4 you have to wait longer. Do you understand? Meanwhile, somebody on H1 will enter and go out, but you are still on your own trade. Yes. Yeah. Yeah.
So if I want to draw the line for the resistance and the support, will it be on top of the curve now?
Yeah, this repeated area of bounce. You can see that when the market approached this area, it came down again. Yeah, so this is going to be regarded as a minor resistance. Yes, resistance. Yes, yes. Yes, no, support will now be this area where it's bouncing from. Yes. No problem. Okay. So now, now that you have seen what your chart looks like, you will observe that what they are using, there's a small red line there, and then is candles, Abi? Yes. That red line you're seeing is called a moving average. Is that okay? It's called a moving average. What a moving average is just telling you, a moving average, the function of a moving average is to tell you the trend. Is that okay? A moving average is like the trend line I drew. If you look at my trend line, you see that it's behind the bottom of the trend. Yeah, no, not the flat one. The red one that is almost, yeah, that is like the price. Is embedded in the price. Because I believe this is 10. This should be 10. So it's embedded in the price. You know what average is? You know average now, quantitative, where they say take average of 5, 6, 3, 2, 2, 5, 4. Give us the average. Is it not? You now take the average and divide it by the total number of sample. Equal to the number. Then you now say the average is 5 or the average is 4. Is it not? Now, that moving average is an average that is moving because a new price is formed depending on your time frame. Is that okay? So when a new price is formed, it will delete the previous one and add the new one and take the average. Do you understand? Let's say yesterday the price of Gary is 2,500 naira. Then the following day it now moved to 2,550 naira. The next bar will go up to 2,250 naira. Do you understand? Now, I'll give you more information on why the bar is used. But before I go there, now see what we're saying, right? On that moving average, because the price changed from 2,500 to 2,550, the moving average will now remove maybe the last, when it was maybe 2,300. It will remove that one and include the 2,550 and take the new average. Is that okay? So it will remove the old one of the old price and now add the recent price. The price of yesterday, it will now add it. And then that when it add it, it will now plot it. That thing is just a continuous plot. You remember physics, when you draw a graph on physics, you now say yesterday's price, the average, after I take the last 10, if my moving average is MA10, it means that I'm taking 10 days information or 10 candles information. Is that okay? So if I'm taking 10 candles, the last one or the first one, I will remove it and then put today's own or yesterday's own. Is that okay? Then they will now take the average and plot. Then they will do again when the next price comes. They will remove the oldest one and bring in the newest price. And then take the average and also plot. Is that okay? So that's how they will keep plotting the average. Do you understand? Then that thing is machine. it will now join the line. Is it not? That's the red line you are seeing inside the price. So it will now join it, and then you can see that because this line is going like this, is an uptrend.
What makes it exponential?
Exponential is it pays more attention to more recent prices. Yes, simple is not making any reference to new price. Exponential will turn faster than simple, because if let's say the price of that garri move from 2,550 to let's say 3,000 the next day, simple will only delete one and add that 3,000. It will not show you that there is now a spike, but exponential will pay attention to that 3,000 and quickly go up to show you that there is a rapid increase in this price.
Why is it then that it says weighted?
Why what?
That the exponential is weighted.
Is weighted to the recent prices. Weight is is a mathematics formula. The mathematics formula calculation for simple is just this plus this plus this plus this plus this plus this over the number of moving average that you are using. If you are using 50 moving average, it's taking 50 bars. When another bar form, it will remove the 49th, or it will remove the first and add the 50 first. So that the new 50 will now be from number 2 to 51. That's what continues to happen. Now, exponential is now saying that if you're using 20 exponential, we are going to pay more attention to, let's say, the most recent 4 bars. So the weight is on the most recent 4 bars. The weight of the result you are getting is on the most recent 4 bars. Linear or simple doesn't put weight on the recent bars. It just add everything and give you the price. But exponential will now say, old prices are gone. Now the market is moving up. So look at it. This market you are looking at has started moving up. Oh. Do you understand now? That red line will now start to turn fast up if it's exponential. But if it's simple, it will just be going the way it's going. You now see that the candle is far away from it. Do you understand? But exponential will turn fast and follow that candle because it's paying more attention to recent prices.
Okay, is that why exponential has lower numbers than simple?
No, you can set any number you want. You can set, when you set number, you are saying this is the number of bars you should take into account. Yes, they have different functions. If I take 20,
I think it's got a little advanced, but let me see whether what he's saying is actually what it is. You know there's this formula you have, exponential 9, 12, 50. I think that was referring to.
and that's what I'm saying.
That is smaller in number.
No, exponential is the same as EMA in terms of number. That number is period. Period is, what period are you talking about? Is it the past 10 days, or the past 10 hours, or the past 10 5-minute bar? If I want to see a longer term trend, I will increase the number. If I increase the number to 50, I'm going to see lesser turns. It will not be turning because 50 bars are many. You understand now? Aha. The strategy I'm going to give you is that's what I'm talking about the MA, so that you understand when we use it. We're going to employ the 20 exponential moving average and the 50 exponential moving average. Right? Aha. So we'll use it as a simple mechanics to place trades. Is that okay? So let's go faster. And then for the bars, there's something you need to understand. See, initially, the way the market was, then the way it was is, if it's just lines that you can have. You see this thing I say, the plot. That's the way data was gotten. In the olden days, when there are no electronic brokers, if you want to place a trade, you have to go to your broker, like over the counter, right? OTC, right? You go to the bank just the way you go to your bank to make a deposit. That's how you go there. Then you tell them, I want to buy gold, or I want to buy euro, or I want to buy this. You count their commission and give them. And then you now carry the money and buy what you want to buy. Are you getting what I'm saying? That's how it was in the olden days. It's now that we can use our phone. That's why we are preaching, your phone can help you make money. Now, you don't need to do that. You don't need to call your broker with phone. Just buy, sell. You have given your broker the order. That one, that's how they give brokers order. Now, let me tell you how they see their price. It's newspaper. There is no, this thing I said all of you should open and look at. They did not have it. So what they will do is, if you see them, they usually have newspaper plenty in their house. Because every day they will release the price at the end of the day of that market. Is that okay? So let's say rice, for example. They will tell you the closing price of rice for that day. Now what they will do is they will now carry the price and now plot it on the graph. Is it not? They'll prepare the day, maybe Monday, Tuesday, Monday 1st, Tuesday 2nd, Wednesday 3rd, Friday. So they now say at the end of the day now, they will now come and write, if the price is 12, they will now come and tick it. Then the next day, if the price now, let's say the price rises to 200, they will tick it according to the newspaper. This is how they got their price. So that's how they keep. If it comes down, they will come and tick it. Right? So that's how they keep doing. So before you know it, they will now come back and join this thing together. That's how they know it's an uptrend. Do you understand? Then they now go to their broker and place their trade. Are you getting this? You see how difficult it was for them. You have to buy newspaper. Now all you need to buy is what? Data. Is it not? Yes. But you still buy something. So but I would prefer to buy data than to buy newspaper. And take price and plot it. Yeah. So yeah, actually. You understand? So these were, the pioneers of this Forex. Forex has started since 1930. Wow. Yes. So that's the way they used to trade. Now I'm going somewhere, right? Yes. Now the point I'm making here is that you can see that they use dots to represent price and lines. But today you can represent the market, the price, which is the rising price, with either line or what we call bars or candles. Is that okay? The very popular one is candles. It's more convenient for you to do your analysis because of the pictorial aid and color too sometimes. If it's line, you cannot change the line to red and green or white and black. Is that okay? You can easily know that, okay, white is going up, black is coming down. Or red is going down, green is going up. Is that okay? But more than that, let me tell you why. Sorry. Let me tell you why they use the candles instead of line. Now, candle gives you more information. See, when you want to use line, the only thing line is going to give you is you are now going to set it to apply to open or apply to close. Meaning that the price in the morning is not the same as the final price at the end of that day. Is it not? There are some things that their price in the morning and their price later in the day will change. So if you're using only line, you will not be able to know the price changes that happened during that day. Because it will only give you the final price. Let's say at the end of the day, something happened, the price just went to, let's say, 2,600. It's only 2,600 that you will see. you will not see that, it was 2.4 at some point. It was 2.5 at some point in that same day. So that's the only reason for candles, actually. Candles, if you see candles now, it allows you to have 4 points instead of just 1 dot. Do you get it now? So line will just allow you to have 1 dot, the final price from that newspaper. Final price yesterday, final price yesterday, final price yesterday. But the candle now will tell you 4 information, right? The candle is going to tell you what was the opening price that day. It will also tell you what was the close price, the final price that day. And then it will also tell you what was the highest price that day. If some people bought that Gary at 3.4 or 3.2, the candle will get to that point to show you that the broker has recorded some persons buying this same Gary at this price for whatever reason. Is that okay? So it tells you the high, and then it also tells you what? The low. What was the least amount? Do you get it? That's what the candles do. So now, when you look at the candle, this is the way they will draw it. They put a wick here, they put body, and then wick. So we call this the wick, and then we call this the body. And then, of course, this is the wick. Okay? So here you have, if this is a red candle, it's different, because the red is going down. Okay? If it's a green candle, I do not have a green marker, but let me show you. If it's green, what you see is that we're saying that the market opened here, right? And then at some point, this thing was full to this point, which is the low. Then it now started going up. It got to this point, which is the high. And then it eventually came down and closed here. So it has more information, is it not? So that's why traders use candle instead of just line. Yeah.
Between that green and red now.
Yeah.
If it were red candle, the position of the open would be the position of the close.
Exactly. Exactly. Who can define open, low, close, and quickly. The open, the close, the high for a sell bar. For a sell bar.
So this will be the highest price that the commodity or the stock, whatever you are buying or selling, this is going to be the highest price. So the price can now come down again and go to this place and reach this place. So this will be the lowest price. So the price can still rise up and now close at this position.
Is that okay? Yes. All right. Yeah, you can clap for him so that, yeah, it's not easy to come here. All right, so you can see that it's very easy to understand. Now, let me tell you the concept here. The candles were, some of you might have come across the Japanese candlesticks. It's a book, Japanese candle. Is it not? Yes. He's a Japanese rice seller, right? He's the one that manufactured or that started the use of candle. He's a farmer. He sells rice from his farm. Now, what he observed is that as a seller of rice, early in the morning, the same bags of rice that he has bagged and kept for people to buy, it depends on who is coming to buy. The price is not the same. If you're coming with trucks, early in the morning at the open, you can buy that same bag of rice that he's selling, let's say, that is normally sold in town at 30,000. The person who is coming with the truck can buy them at 18,000. Do you understand? And then he transports them to wherever and sell to people who will further sell. Is it not? Yes, both wholesalers and retailers, because this person is coming from the farm. Is it not? Now, let's do a representation of what I'm saying so that you see the reality behind, the candle and all of that. So now what you see is that he has sold to some persons at 18,000 naira, the same rice, right? So what we now say is this is the opening price, is it not? Yes. It's the opening price. Now, what happens is that some of these people who bought the rice will now go to town and sell early in the morning. That same rice that he sold at 18,000 can be sold at, let's say, 25,000 naira. Is it not? Is it not? Yes. And then some people will buy and sell in smaller quantities. At the end of the day, you see that one bag can get to 28,000 or thereabout. Is it not? Yes. Aha. So you see that this price from this point will experience, increase. Now, let's assume that those who retailed and did all of that, they eventually sold at 28,000 naira. Now, do you know that towards the end of the day, some of these people who maybe they are selling with their wheelbarrow or they come out to the market, have you gone to buy market from somebody in the evening and the person will say, oh, yeah, just give me and just take everything. Let me go and meet my children, or let me go and meet my husband. Is it not? Meat sellers. Some of you wait till that time to buy meat. You buy spoiled ones. So what will happen is some of them can now say, okay, take it at a lesser price, and then you can now see that this same rice can come down to about, let's say, 23,000. Is it not? Because they are planning to go back to farm the following day. Is it not? So you can see that there have been changes on this price. Now, mind you, some persons can go to that same farm, and let's say they are buying a bigger number. Do you know that it's possible for the farmer to say, okay, since you are buying this, take at 17,000. Is it not? Yes. You can say take at 17,000. So you can see that we can have he looked at this and said, no, we can't just say that price is 23,000, which is the last price. Do you get the point now? We can't say that the close is the only price. Other things happen. This thing increased. It went down. And different things can happen. When Buhari says no more importation of rice, it will rise. The best way to see it is the previous day. Because the last set of people that will be buying 29,000, 30,000. Is it not? Yes. And then this thing will not come down to 23. You're going to have what we call a marobuzu, a bullish bar, that shows that there's no rejection of price at the end of day. Do you understand? It's a strong bullish bar. Bullish is for buy, green. Bearish is for sell, red. Bullish means that, you know how the bulls, they fight. They raise you up. Then the bear will fight with their power. They pull you down and eat you up. So they drag you down. Meanwhile, when a bull is coming, he's coming like this to raise you up. So that's why we say this is bullish bar. And this is a bearish bar. Is that okay? So this belongs to the bears, this belongs to the bulls. All right, so we can represent this as a candle. And then when we want to draw it, who can draw this candle for me? Let somebody else try. Who can draw this farmer's information? Who can draw it? So show us, using a candle, the price change during that day. No, that place is enough if he knows.
All right.
Okay.
This is opening. Sorry, this is opening here. 18,000.
Yeah.
Then the price goes up to the high. That's 28, right?
Sorry, dear. No, but yeah, you might have your own style or idea, but this is also correct. It's correct. Because this is exactly what the candle says. So this is what the farmer started doing. But he was using bars, not actual. So this was how he would represent it. So the price will now start from here. It will go down a little bit. And then go up all the way to this point and come down. If you look at bars, you see that that's how they look. They just have one small something here and another one here. Is it not?
Yes.
Aha. So that's how they did it before it now grew and became candles. Do you understand? So today what you see is candle. Tomorrow, in fact, not even tomorrow. There are other things now, even as we speak. There's what we call hinky ashy. Right? Yeah, there are other things. Yes. So, but is not with time. Some people use it. Okay, but if I don't find a reason to use something, I don't use it. So you don't make your work too complex for yourself. So you understand what bars are, right? Now there is a concept I want you to understand with bars. Every bar is either a trend bar or a non-trend bar. Is that okay? Every bar on your chart is either a trend bar or a non-trend bar. So when you are looking at a bar, if a bar, look at what I want to explain here quickly. If a bar has a big body, that is a full-bodied bar, it is formed from a trend. Do you understand that? If a bar, look at this. If the market goes up like this, come down, go up, come down like this, right? And let's say that this is a 5 minutes chart. You have seen your chart. You have seen different time frames, is it not? Yes. If I say this is a 5 minutes chart, it means that every 5 minutes, one candle will form. Is that okay? Yes. When you have 451, 452, 453, 454, 455, 456, 457, 458, 459, 500, the candle will close. The next one will start. That's for scalpers. That's the kind of market they look at. So they analyze the bars in that low time frame and place their trades. Is that okay? Okay. So now what we are saying is, if I have 5 minutes bar, do you know I also have daily bar? Right? 5 minutes bars. I can have bar, you know, here. Can have bar coming down like this. Is it not? 5 minutes each. Do you understand? 5 minutes each. Some will be big, some will be weaks. Red can mix with a little green. Is it not? Because it's not all, you know, one color. It's hinky ashy that is all one color on the swing up. So they are trying to tell you, don't be deceived. It's still going up. Do you understand? That's hinky ashy. Okay? Don't be deceived. It's still going up. All right? So now this is 5 minutes. Now, but if I go to 1 hour, 1 hour will have how many bars? How many 5 minutes bar? 12. Is it not? So if I go to H1 time frame, I'm going to, if I look at 1 hour, 12 of these bar will now equate to one H1. Is it not? If I go to daily, 24 H1 bars will equate to one single bar, which is daily. Do you understand? Now, if all of this is 5 minutes, it means that at the end of the day, the big bar I have is what? Daily. Do you understand? I have 5 minutes here, 5 minutes, but this one is daily, and it's formed from this uptrend. Does it make sense? Make sense, Abi? Now, what I'm trying to explain here is all these concepts are not easy to grasp at once. So I'm doing my best, and I know I might be too fast for some of you. But with time, you will appreciate these things. Is that okay? Especially those who are very new. Even if you're not new, I'm sure you're still learning some things. Is it not? So the point I'm making here is, all these constitute only one single bar. That is why I told you that a bar can either be a trend bar or a non-trend bar. A non-trend bar, who can tell me where a non-trend bar is formed from? If I have a non-trend bar, what costs that? If I look at a daily bar and it's not a full body candle like this, what costs it? Range. Is it not? It's consolidation, range. So if the market did not trend up, it means that the bar will not be a trend bar. So when I have a full-fledged candle like this, it shows that there is a trend. But if the market is just going up, down, no particular direction, at the end of the day, when you look at your bar, you will just see maybe a wick like this, something like this. Is it not? It will not be a full-bodied candle. So this type of bars are called non-trend bars. When we teach you candles, there are different types of candles. They have many names. But if you understand this concept, you understand what I'm trying to say. Now, what I want you to get is something that we're going to use for my strategy. The strategy is going to constitute of these two guys. Now, see the point. Before you place a buy order, you're going to look out for an indecision bar and a trend bar. The reason is this. We are assuming that when all of these things happened, the market was struggling. Indecision means struggle. Is that okay? They are fighting. Bulls and bears are struggling for who will accept which price. Now, what we are saying is, if at the end of the struggle, a green bar emanates and we have an uptrend, is a sign that the struggle is over and the new trend has been formed. Do you get that part? See what I'm saying? See, this is broken down. This is this. Trading range, is it not? Yes. Now, when something like this happens, what does it imply? It implies that trend has started. There's a breakout, is it not? Yes. Now, all of this thing from here to here is what? Is range. Is it not? Yes. Then when this area happens from here to here, what do you see? Breakout from here. Is it not? It's a breakout. And what follows the breakout? After the trading range and the breakout, you see a trend. Is it not? Now let me tell you what you will do. That your 1,000 naira I've been telling you about, you will now factor it into this height of the candle. Is that okay? So your indecision bar and your trend bar, you factor in your 1,000 naira into their height. If this candle is, let's say, 11 pips tall, depending on your time frame, we count it by pips. Is that okay? It's pips. The pips is the height. Pips is analogous to centimeter or kilometer. Is that okay? So, but we cannot say kilometer here. What we say is pips. Is that okay? So, so from here, you know, the pips, you have number of pips is 11. So what you will now do, you will now tell your calculator that, please, I am going to take a risk going upwards of 11 pips. And I want, if this thing go against me, I want to lose only 1,000 naira. The calculator will now tell you what order to give the broker. Do you understand? The calculator will now tell you, okay, buy this amount of, or buy this volume, let me not use amount. Buy this volume of the pounds. If you buy, the calculator will now tell you, remember I was telling you about 0.01 yesterday. Yes. So now the calculator will now tell you, okay, use 0.13. If you use 0.13, if the market goes against you, meaning that after this indecision and trend bar forms, it triggers your order, right? That it starts your order, then it now starts to reverse. And then it now comes back down like this. This is unexpected, is it not? Yes. From what I've explained so far about trading range, breakout, and price and all those things. You know that the price is starting to go up. We are expecting that the price will go at least twice the height of these bars. Yes. Upwards. Yes. Is it not? Yes. Now, we are not worried about that. What we are concerned is that from this bar height to the base of this bar, I'm factoring in 1,000 naira. So if you go against me, 11 pips, all I'm going to lose is 1,000 naira. So this is what you will use, whatever your calculator gives you. This is fictitious, is it not? I'm just giving you a number. So you press it. It's like normal calculation when somebody buys something from your store. You tell the calculator asks you how much you want to risk. You say 1%. How much is your account size? You say 10,000. Is it not? Or 100,000. Then he will now ask you how many pips is the stop loss going to take? Is it not? You now say 11. Do you get it? Then it will now ask you which market are you buying. You now say Euro USD or AUD card. Is that okay now? When you give the calculator this four information, it will now give you the number. We call it the standard lot. So it gives you that standard lot. You now use that standard lot and place it where your broker asks you what's the volume you want to buy.
So it's
Yes, because we are saying that they were fighting, and now we have seen who won. Yes, the trend bar has to close. So you are now going to put your buy order above that trend bar. So that if genuinely you have a trend, the next wave now will now pick you. In the next couple of bars, you should get to your target. That's why we are day traders. Because if you're trading a 1 hour time frame, and if you're trading a 1 hour time frame, this one happened, let's say 7 a.m. in the morning, or 4 a.m. in the morning, and then this one now happened 5 a.m. in the morning, and maybe you wake up around 6 before going to work, you can see that you have indecision and trend bar on your moving average. Is it not? I'm talking about a simple strategy now. Pull back to your moving average, they now started fighting, and then they now want to resume the trend. Is it not?
Yes, sir.
So what you now say is, look at what we are doing. We are saying that we are expecting the market to go up. We are looking for these two bars at the base here. So that when it goes back up, we will get to our target. That is twice the height of this bar. Do you get the picture now?
Yes, sir.
So now, stop loss will be here. Your entry order will be 1 tick above that bar. So if you are right, when the next bar starts to form, it will trigger your order. Is it not? New bars will now be formed. When they get to twice the height of this your stop loss, you place your target already.
Did you say the entry will be 1
1
stick above?
tick.
1 tick.
Yeah. Tick. It depends. I don't like to say 1 pip because if you're using daily, 1 pip will be insignificant. So 1 tick is depending on your chart. If you're using 5 minutes or 1 minute and you use 1 pip, your 1 pip is far away. Because we have micro pip. You need 10 micro pips to get to 1 pip. So what we're saying is 1 tick is just give it a breathing space. From where the, from the week. From the week, just give it some space. So that if actually, and then the week on a trend bar is not too much. That's what makes it a trend bar. So you just right above the candle, just a little space, put your order there. So if the market starts to move, if it's moving in your favor, it will trigger and go all the way to your target before the end of the day. Right?
Can we put it up and your pending order in case it's coming down?
No, you cannot do that, sir. It's a very good question now. It's a very good question. What he's talking about is called hedging. It's called hedging. But it's not advisable. Because the only people who can hedge are people who have a lot of money. So they buy and sell at the same time. Then when he starts to sell and they are okay with the amount, they close it and wait for whenever the sell order will go back and return to profit. It's called hedging. You can't do it with our $100. Because before the market will come down and give you profit, the $100 and the profit and everything is to take it away. So you can't do that. Right? So it's hedging. You have to be decisive. Because at every point in time, the market will make you feel like it wants to buy and it wants to sell. So you need a strategy. So this is an example of what I'm talking about when I say strategy. The strategy is not complete yet. I'm just showing you. Right? So this is what we mean when we say, okay, strategy. You need to, now this can be my own rule. Like I've told you. I say, okay, anytime I see this bar and this bar, I'm going to risk 1%, is it not? Then maybe I will do it on GBP, NZD, AUD, USD, Euro, USD. I'm done for that day. Is that okay? The three of them will not all lose. Do you get my point? Yes, of course. Because if I'm in an uptrend, like as we have in this case, if the market is in an uptrend, you cannot come and say indecision. Who do you expect to emanate as the winner? In an uptrend? The bulls. So what color? Green. So if I have indecision after the struggle, I now see red. What does it mean? Bearish. Do you understand now? So that can be a very simple strategy that traders can use to trade. Is that okay? Yeah. That's why you are in a workshop. But I'm afraid that we might not be able to go too deep. You understand? Yeah, a little bit. Yeah, I'll show you something. The what? No, but up until now, it's sweet. So, but you are the one clamoring for us to go and show you. When I start to show you now, you now say, okay, where is the place we put the number? Then before you know now, you now say, nah, it's like this thing. But what I've said to you already makes sense, is it not? Yes. So if you have the patience to learn it well, you will do it. Do you understand? So if you have the patience to stay and understand it, know where the number should be, know how the candle should look like, and where you should buy from, you will you will do it. That's why I don't go into it already, because if I try it, half of you will sleep. Some of you are sleeping already. But I'm trying my best, you know. But you are still sleeping. So, but there's little or nothing we can do about it. So I've taught you about all these things. These are just representations, so we won't waste time here. This is what I was talking about. That's the man, Elliott. Yeah, so he says it goes up, comes down. That's the way it moves, and then it will rest. So you can see this is a big rest. This is a smaller rest. So this rest is the rest of all of this. Do you understand? Meanwhile, this small rest is from here. It's like taking a breather. That's why we say the market would never go straight up or straight down. And the market is designed to create confusion. All these guys did is they tried to remove the chaos, that's confusion. When you open it, as you are opening it, are you not confused? And some of you will look at it and say it's a trading range. I will just smile. Because that is what you are seeing for now. Is it not? So it's confusion. All right? So, but trends are very clear. Yeah. More like it. Okay, so what we're saying is this is what market looks like. You can see this is the wave 1. You can see that it's now getting complex. Wave 2 is this pullback here. This is wave 3. So when you're using line and when you're using actual market, it's not the same. So I know what I was saying. So you can see now this is wave 1 from here to here. From here to here is the second pullback. You're seeing it. So it now goes up to this point as wave 3. And then it comes back and goes here as wave 4 rest. Before it now push again, the final one. Do you see it? And then we'll now take a very big rest, which we call ABC. Is that okay? So this is what Elliott described for us. Yeah.
Sorry, before
I thought there were some way before the wave one. How would I know that that's wave one?
And that's the problem now. The only way to know is that Elliott has given us some rules. We call them Elliott wave count rules. Is that okay? So he has said that this wave one this one will not go lower than this. Is that okay? Wave 2 must not be lower than wave 1. Wave 3 must be the longest. Is that okay? Wave 4 should not interfere with the wave 1. So wave 4 should not come down and go lower than this wave 1. So that's the rule. So when you have this rule, you label it as wave 1, 2, 3, 4, 5. Then you can see where traders are looking to buy from. After A, B, and C, this is A, this is B, this is C. Are you seeing it? So it's from C, they know that, okay, we can now clearly label. It is what you have on the left side of your chart that you use to place your trade. Is that okay? So Elliott wave traders have seen that, okay, we now have wave 1, 2, 3, 4, 5, clear. Now what we have is A, B, C. From C, there's nothing else again apart from a fresh wave. Do you understand now?
Wave 6, is it now wave 3?
No.
Okay, that's the rest.
The rest. The big rest of the entire wave. So when it gets to C, you can see this green arrow. That's what happens in our Telegram in the signal area. So they will now show you, okay, this is the direction the market is going to move. So you can see them predicting that it will move this way. Now, it is an edge because what? You have read the market, you have analyzed it, and you can say, okay, this is where it's going to go. What you will now do is, you now say, okay, I'm going to put 1,000 naira on it to see whether it will actually go. Do you get the point now? So strategies differ. They differ. Yeah.
In that diagram, we have some up and down there. Why don't you number like this?
Yeah,
with one would do another. Why don't you?
There are different types. It's a good question. There are different types. Now, there is the complex pullback. There's diagonal pullback. There's simple pullback. There are different types of pullback when you're talking about Elliott. Now, Elliott is now saying that with IV, and V, which is this 5 corrective wave, all of them make up the last leg. Do you understand? So this is deeper. Is it not? It's deeper. So you can see IV. So he's saying that he's going to buy when this thing drops to this level. So it means that V is complete. This is the 5-wave correction. It's usually not simple like that. That's the truth. So it's just that you need some time. And then some people are Elliott wave traders. This is what they do. Do you understand? This is their strategy. They will just look at the chart and count 1, 2, 3, 4, 5. Then they will start to look at the pullbacks. If you exceed, if they see that from here to here, you are now pulling back, you are going lower than this one, they will now label it I. Is it not? What they are expecting is IV and V. Yes, before they will now see the V, and then it will give them a fresh opportunity again. They know that nothing can happen again from that point, apart from a fresh move. So they place their trade. Okay? So yeah, these are the rules I was talking about. You can see it. Wave 1, 2, 3 are directional, in the direction of the market. Then they say wave 2 and 4 are counter moves, which is corrective moves against the trend. That's wave 2 and wave 3. Okay, so you can see this is wave 2, corrective. Wave 4, corrective or counter. Okay, 1, 3, 5 are what? Directional. We call them impulse waves. They are directional. Those are the rules. Wave 2 will never move below wave 1. You can see it. It will never move below this wave. Wave 3,